So we primarily invest in UK-listed dividend-paying stocks. And that's because our fund has two aims. One, to try and generate total returns ahead of the FTSE All-Share, and also an income stream ahead of the FTSE All-Share. We measure both of those over the medium to long term. We can invest right across the market cap and style spectrum. We don't ever constrain ourselves by saying we'll only ever buy mid-cap growth or large-cap value or quality. We think there's a real advantage in having the ability to invest right across the market as the investment environment and valuations change. So we've flipped the traditional investment process on its head. Instead of blue sky thinking about how much can an investment possibly make, we try and look at downside scenarios, realistic downside scenarios, and assess how much of those are incorporated in the current share price. We're following the old investment adage, if you look after the downside, the upside will take care of itself. We call that approach winning by not losing. In terms of specifics, we follow the trinity of risk approach. So we're looking at business risk. How good is management? How good is the business model? How exposed is it to the macro? We consider financial risk or balance sheet risk. So we're looking at how appropriate is the company's debt structure for the kind of cash flows the company generates. And finally, price or valuation risk. How cheap or expensive are the shares? How much of a margin of safety is built into the current share price? Even if you invest in the best business in the world with the best management team, you can still lose a significant amount of your money. So from that process, we create a high conviction portfolio of 40 to 50 stocks. So to beat the benchmark, you have to do something different to the benchmark. So we'll happily take on benchmark risk. Inevitably, that will mean that from time to time, our performance will deviate from the benchmark. But thankfully, we can demonstrate that in the almost 25 years that our team has been running this fund, our active approach has added significant value for our clients. In terms of other risks, currency is a big one. Many of our holdings generate significant profits overseas. Some of them pay their dividends in foreign currency. We don't hedge that, so you could view that as a risk, or perhaps it's a diversification benefit. And in terms of how we manage the risk within the fund, well, downside risk mitigation is a key part of our process. It's what we do day to day. So we think it's a real advantage of our fund. So we have to be clear on this, the Rathbone Income Fund is not an ESG fund. However, we have always incorporated ESG factors within our trinity of risk framework. We think it's vitally important that we understand the big ESG risks and how they may impact the future returns of our companies. So obviously it depends on the client, but we see our fund as offering two primary benefits. Firstly, it offers diversification away from the US market, growth stocks, and tech stocks, which have come to dominate many investment portfolios. We saw that diversification benefit play out in 2022. Secondly, we're hearing more and more from advisors and clients about the need for flexibility when it comes to income generation in later years, particularly given the changing retirement landscape. We think our fund, with its focus on both total returns and a growing income stream, can offer part of the solution, both pre-retirement, during retirement, and post-retirement.